Before we begin, a quick and important disclaimer. The information provided in this video is for educational and entertainment purposes only and does not constitute professional legal, financial, or insurance advice. The topics discussed, particularly those involving marriage law, asset division, and insurance products, are subject to complex regulatory frameworks that vary significantly by state and individual circumstance. Viewers are strongly encouraged to conduct their own due diligence and consult with qualified legal counsel or certified financial professionals before making any decisions regarding their personal or marital estate. Imagine a contract that fundamentally changes the moment you sign it, yet you are rarely told how the clauses function until the day you want to leave. For decades, the American marriage contract was viewed as an immutable, social, and religious monolith. However, in the last 40 years, the economic reality of the American household has undergone a tectonic shift. We are currently witnessing a period where the financial architecture of the American family is being completely rewritten, not just by cultural norms, but by cold, hard economic data. Today, we are looking at a reality where nearly half of all marriages face dissolution, and in the wake of this, a brand new sector of the economy is emerging. We are talking about the rise of divorce insurance, high-stakes prenuptial engineering, and the systematic commodification of marital stability. If you believe your union is immune to the economic forces sweeping through the U.S. middle class, you are looking at the world through a lens that was shattered in the late 20th century. Why are more individuals now approaching their romantic partnerships with the same calculated risk management strategies used by hedge fund managers? And more importantly, what happens to the concept of love when it becomes an insurable asset class? The problem this series solves is one of profound uncertainty. For the modern American, marriage is often the single largest financial transaction of a lifetime. Yet, unlike buying a home, starting a business, or investing in the stock market, most people enter this contract with zero risk assessment, no exit strategy, and a total lack of understanding of the economic implications of divorce. You are here because you have sensed that the traditional model is no longer sufficient. Feel the anxiety of the modern economic landscape, where dual income dependency can lead to total insolvency if a partnership dissolves. By the end of this 10-part deep dive, you will understand the intricate mechanics of marital economics, the evolution of divorce as an economic event, and the emerging tools, including specialized insurance products, that individuals are using to navigate this volatile landscape. We are moving beyond the surface-level debates about culture and focusing exclusively on the ledger, the assets, the liabilities, and the long-term economic consequences of modern matrimony. To understand where we are, we must look at the historical trajectory of the American household economy. In the middle of the 20th century, the economic structure of marriage was largely binary. You had the primary earner and the homemaker. Financial risk was centralized and mitigated by long-term corporate employment and robust social safety nets. Divorce was rare, stigmatized, and legally difficult to obtain. When the no-fault divorce revolution began in the late 1960s and accelerated through the 1970s, the legal barrier to entry for ending a marriage was lowered, but the economic complexity exploded. Suddenly, the marital contract became an ongoing negotiation, rather than a static lifelong agreement. Data from the Bureau of Economic Analysis and various sociological longitudinal studies indicate that this shift changed the psychology of household investment. When the probability of dissolution increases, the incentive to invest in specific marital assets, such as shared real estate, joint retirement accounts, or even the professional development of one spouse over the other changes. Rational economic actors began to hedge. We started to see the normalization of the prenuptial agreement, which moved from being a tool for the ultra-wealthy to protect dynastic inheritances to a standard instrument for dual-career professionals trying to disentangle their individual assets from the collective unit. However, the prenuptial agreement is a static document. It is designed at the point of highest optimism, often years before life's most significant financial events occur. This is where the gap in the market becomes obvious. If life is dynamic, why is our protection against the loss of a household economy so static? This creates a massive void that modern financial products are now attempting to fill. We are seeing the early development of products loosely termed divorce insurance. Now, it is important to clarify that this is not a product that pays out in the event of a fight or a minor disagreement. These are specialized indemnity products designed to hedge against the massive wealth destruction that can occur during the dissolution of a partnership. Consider the classic scenario of the stay-at-home parent, who sacrifices their career advancement to manage the domestic sphere. From an economic perspective, this is a massive capital investment in the household. If the marriage ends after 15 years, that spouse faces a catastrophic loss of lifetime earning potential. Traditionally, alimony or spousal maintenance was the mechanism used to address this, but courts are increasingly moving away from long-term support in favor of rehabilitative alimony. This transition leaves a significant financial vulnerability. Where does the value of that lost career go? It vanishes. Insurance models are currently being explored to quantify and mitigate this specific type of human capital loss. We are also seeing the emergence of high-frequency data analysis applied to family law. We have transitioned into an era where every transaction, every credit card statement, and every investment decision made during a marriage creates a digital footprint that is scrutinized during the divorce discovery process. The economic cost of discovery alone has turned divorce into a high-stakes litigation battleground. In the coming segments, we will dissect how legal technology and forensic accounting are not just changing the speed of divorce, but the actual net worth outcomes of the parties involved. The shift toward viewing marriage as an economic entity is not necessarily a cold or cynical development. It is a pragmatic adaptation to the current U.S. economic reality. When you look at the volatility of the modern job market, the increasing cost of housing, and the stagnation of real wages for the middle class, the failure of a marital economic partnership is one of the highest risk events an individual can experience. Treating it with the same level of analytical rigor as any other major financial endeavor is simply a survival strategy in a complex environment. We are going to deconstruct how you evaluate your own marital estate, how you identify hidden liabilities, and why the old ways of thinking about marital property are failing to protect the modern American family. We are going to look at the intersection of psychology and balance sheets, exploring why the most successful financial planners now integrate estate planning, insurance, and risk management directly into the conversation of marital health. This is not about predicting the end of your marriage. It is about fortifying your economic position regardless of the outcome. You are about to enter a space where the math of the household is laid bare. To ground this exploration in reality, we have to move past abstract concepts and look at the actual architecture of the household balance sheet in 2026. Most people view marriage as a romantic union, but from an economic standpoint, a marriage is a complex, long-term merger of two separate financial entities. When this merger occurs, the legal and financial integration is often total, yet the documentation of that integration is frequently left to chance. Consider the case of Sarah and David, a professional couple living in Chicago. In 2020, they entered their marriage with a combined household income of $250,000 and a mutual goal of purchasing a primary residence. Over the next 6 years, they consolidated their debt, merged their retirement accounts, and made joint investments in taxable brokerage accounts. When they encountered a decline in their marital stability this year, the economic fallout was not just about the loss of their relationship. It was about the massive, complex process of disentangling 6 years of commingled assets. This process is what legal professionals refer to as equitable distribution. In many U.S. states, this does not necessarily mean a simple 50-50 split of everything. It involves a granular, often contentious process of determining what is marital property and what is separate property. Imagine the nightmare of a forensic accountant attempting to trace the origin of funds used to renovate a kitchen in 2023, when those funds were drawn from a joint account that was partially funded by an inheritance received in 2021. If the inheritance was deposited into a joint account, it might have been legally transmuted into marital property. This is the level of detail where the math of the household becomes punishing. Sarah and David discovered that their lack of a pre-existing economic exit strategy meant that a significant portion of their combined net worth was swallowed by legal fees and the forced liquidation of assets during a suboptimal market window. What makes this situation so pervasive in 2026 is the sheer scale of the modern marital estate. We are seeing a higher prevalence of dual-income households where both parties hold equity in various companies, possess diverse retirement accounts, and manage complex tax-deferred assets. When these portfolios collide and subsequently separate, the transactional cost is significantly higher than it was for the households of the 1980s. The traditional approach to divorce has been reactive, focusing on the division of assets after the relationship has already fractured. However, the current trend is shifting toward proactive economic structural design. Individuals are now seeking advice on how to structure their financial lives from the very first day of their union, much like business partners drafting a detailed operating agreement. This shift has created a market for what we might call defensive financial engineering. It is not just about the prenuptial agreement anymore. It is about how title is held on real estate, how beneficiaries are designated on life insurance policies, and how tax strategies are formulated to prevent the total erosion of wealth in the event of a separation. Imagine if, at the time of the wedding, the couple had established a structured system for tracking the growth of individual versus joint assets. If a spouse brought a retirement account into the marriage, they could maintain its separate nature by strictly adhering to contribution protocols that prevent commingling. This is not about being cold-hearted. It is about maintaining clear accounting records that make the eventual legal process, should it ever become necessary, a matter of routine clerical work, rather than a high-stakes litigation battle. The data supports this need for structural clarity. According to current filings, the average cost of a litigated divorce in the United States continues to climb, driven by the increasing complexity of modern asset portfolios. When you factor in the opportunity cost of time, the emotional toll, and the loss of long-term investment growth due to the liquidation of assets, the true cost of a poorly managed divorce can exceed 40% of the total marital net worth. This is the economic tax that society pays for failing to view the marital partnership as an insurable, manageable entity. There is also the critical issue of alimony, or spousal maintenance. In many jurisdictions, the laws governing these payments are becoming more data-driven and formulaic. Judges are increasingly relying on actuarial tables to determine the duration and amount of support, based on the length of the marriage and the disparity in earning power. This transition from discretionary judicial decisions to formulaic calculations makes it much easier to model the potential economic outcomes of a divorce years in advance. If you know the formula your state uses, you can simulate the financial impact of a divorce as easily as you can run a retirement projection. This transparency allows for a new level of risk assessment that was simply not possible for previous generations. When we talk about the potential for divorce insurance, we are discussing a product that essentially hedges against the volatility of the marital partnership. While true insurance products for divorce are still in their infancy in the U.S. market, the underlying logic is gaining traction. Just as a business uses key person insurance to protect against the loss of an essential employee, individuals are beginning to look at their own income-generating capacity and the household's dependence on that income as a quantifiable asset that requires protection. If one spouse is the primary earner, the other spouse is effectively invested in the stability of that partner's career. When that career is successful, the household prospers. When the marriage fails, the non-earning or lower-earning spouse faces a sudden loss of their primary investment vehicle. This brings us to a crucial question that most couples are terrified to ask until it is too late. If the economic survival of one person in the marriage is entirely dependent on the other, how do we treat that dependency with the same risk mitigation standards we apply to our investment portfolios? We are looking at a future where financial literacy includes not just understanding how to invest for retirement, but understanding how to safeguard your net worth against the most common cause of middle-class wealth destruction. In the next part of this series, we will peel back the layer on the specific legal instruments that are revolutionizing how people handle these assets, starting with the evolution of the prenuptial agreement from a taboo subject to a standard economic tool. We will also examine why the most successful, long-lasting partnerships are the ones that have already modeled their own worst-case scenarios, and why transparency is the ultimate hedge against catastrophe. The math is waiting for you. Are you prepared to look at the numbers, or will you continue to operate in the dark? If you choose to continue operating in the dark, you are effectively betting your entire financial future on a static, informal, and often poorly defined verbal agreement. In the landscape of 2026, where digital assets, complex equity compensation packages, and multi-state real estate holdings are standard for the middle-class professional, the archaic approach to marriage is not just outdated, it is reckless. The prenuptial agreement, long misunderstood as a sign of distrust or a predictor of failure, is undergoing a profound rebranding. It is now becoming the standard operating procedure for the financially literate, who understand that clear boundaries are the bedrock of long-term stability. Consider the case of Jordan and Elena, a couple in their early 30s living in Austin. Jordan is a software architect with a significant portion of his net worth tied up in unvested restricted stock units, or RSUs, from a publicly traded tech company. Elena is a physician with a private practice that she built during their 4 years of marriage. When they initially discussed their future, they assumed that since they were both professionals, everything would simply sort itself out. But what happens if the company Jordan works for undergoes a merger? Or if Elena decides to expand her practice by taking on a heavy debt load? Without a prenuptial agreement that explicitly defines the treatment of appreciation in the value of their separate businesses and the characterization of unvested equity, they are leaving the determination of their financial futures to a judge who has never met them and does not understand the nuances of their career trajectories. The prenuptial agreement is the primary tool for shifting the default rules of the state to the specific needs of the individuals. Every state has a default set of laws that dictate what happens to property upon divorce. If you do not sign a contract that explicitly overrides these, you are implicitly agreeing to let the state decide how your life's work is divided. In many jurisdictions, this leads to results that neither party would have chosen for themselves. For instance, in an equitable distribution state, a judge might decide that the increase in value of a premarital business due to marital effort is a marital asset. If the business owner has not carefully documented the distinction between their personal labor and the passive growth of the company, they could find themselves forced to pay out a massive sum that was never intended to be part of the communal pot. The process of drafting a solid agreement is an exercise in brutal, necessary transparency. It forces both parties to sit down, disclose every single asset, liability, income stream and expectation, and reconcile these with the other person. This is the ultimate stress test for any partnership. If you cannot have a candid, data-driven conversation about money when the relationship is at its strongest, how can you expect to have a productive negotiation if the relationship ever reaches a breaking point? Many couples find that the process of creating a prenuptial agreement actually strengthens the bond because it removes the looming, unspoken fear of financial catastrophe from the table. It replaces anxiety with a written, clear understanding of the financial landscape. We must also address the common misconception that prenuptial agreements are only for those with significant existing wealth. This is a historical remnant of a different era. Today, the most vital reason to have an agreement is to protect future growth, manage debt, and set clear expectations for the financial trajectory of the household. If you are a young professional with student loans and an expectation of high future earnings, your future income is one of your most valuable assets. How that income is treated, how debts are managed, and how retirement savings are siloed are all decisions that are best made when both parties are on the same page. By failing to formalize these arrangements, you are essentially creating a situation where any future disagreement over finances is amplified by the lack of a clear, pre-existing roadmap. Furthermore, consider the tax implications. The IRS does not care about your emotional state during a divorce, but it certainly cares about how assets are transferred between spouses. A poorly structured division of property can result in significant, avoidable tax liabilities. A well-constructed agreement provides a roadmap for the division of assets that minimizes tax impact, preserves wealth, and ensures that the transition is handled as efficiently as possible. We are talking about the difference between a clean split that preserves the financial viability of both parties and a destructive event that triggers capital gains taxes, early withdrawal penalties on retirement accounts, and the erosion of assets due to liquidation. The data shows that couples who invest the time and effort into formalizing their marital economics are more likely to have a clear understanding of their long-term financial goals and are better equipped to handle the stresses of modern life. They are not predicting divorce. They are preparing for the reality that the world is unpredictable. They are building a financial structure that is resilient to external shocks, whether that be a career change, a market downturn, or a shift in the status of their union. However, the prenuptial agreement is only the first piece of the puzzle. It is a static document designed to handle the transition, but it does not account for the ongoing dynamic nature of marital economics as the decades roll by. We have established that the landscape has changed, the risks have scaled, and the tools are available to navigate this. But what happens when the marriage is underway and the financial goals evolve? How do you maintain the integrity of that balance sheet as the years pass and the complexity of your joint life inevitably deepens? In the next part, we will explore the critical, often ignored concept of marital asset maintenance, and why the most successful couples are those who treat their marriage as an actively managed portfolio. We will dive into the specific systems for tracking commingled versus separate property over time, and why the most sophisticated households now hold regular financial audits to ensure their plan remains aligned with their reality. The path to economic clarity is opening up, but the work is far from over. Are you ready to see how the most elite financial planners are structuring the middle of the marriage? Or will you wait for the next crisis to force your hand? To wait for a crisis is to accept that you have no control over your own economic destiny. The most dangerous assumption in any long-term partnership is that the financial structure established at the beginning will remain relevant or accurate 5, 10, or 15 years down the road. In 2026, the complexity of the household economy is not static. It is fluid, shifting with every career move, every investment decision, and every change in the regulatory environment. This is why the concept of active marital asset management is no longer a luxury for the ultra-wealthy, but a necessity for any household that values long-term stability. Imagine the situation of a couple like Mark and Jessica in Denver. When they married in 2018, their primary assets were a joint savings account and their individual retirement plans. By 2026, they have expanded their portfolio to include a rental property, a small business interest, and multiple tax-advantaged investment accounts. If they rely on the same financial assumptions they held 8 years ago, they are likely ignoring the reality of commingling. They have been paying the mortgage on the rental property with funds from their joint checking account, where their salaries are deposited. In many jurisdictions, this simple act of using marital income to pay for a premarital or separate asset can potentially convert a portion of that asset into marital property. Without an active, documented system for tracking these contributions, they are inadvertently dismantling their own financial defenses. The process of active marital asset maintenance begins with the implementation of a formal, periodic financial audit. This is not just checking your bank balance or paying your credit card bill. This is a deliberate, scheduled review where you and your partner sit down to evaluate the status of your combined and individual assets. You should be looking at the title of every piece of real estate, the beneficiary designations on every retirement account and life insurance policy, and the origin of the funds used for every major purchase or investment. You are looking for instances where the line between your individual financial interests and your joint interests has become blurred. This audit serves 3 critical functions. First, it ensures that your financial reality is accurately reflected in your documentation. Second, it allows you to identify potential vulnerabilities before they become irreconcilable problems. Third, it maintains a clean, transparent trail of financial activity that can be invaluable in any future legal or tax-related scenario. Think of this as the maintenance schedule for your house. You would not go 10 years without checking your roof for leaks or your foundation for cracks. Yet most people go decades without performing an audit of their marital balance sheet. We need to discuss the concept of asset tracing. In a potential dissolution, the ability to clearly define what is yours, what is theirs, and what is ours is the most important factor in determining the economic outcome. When you engage in active maintenance, you are essentially building a digital and paper trail that tells the story of your assets. If you receive an inheritance, do you keep it in a separate account in your name only? Do you keep records of that money, never commingling it with marital funds? If you do, you have a strong documented position. If you deposit it into a joint account and then use it to pay off the family mortgage, that clear boundary is gone. These are the small daily decisions that have massive long-term financial consequences. We are also seeing the emergence of what can be called marriage portfolio management services. This is a burgeoning field where couples employ financial planners who specialize in the intersection of wealth management and family law. These professionals help couples build structures that are designed to survive the volatility of the marital partnership. They assist in drafting post-nuptial agreements, which are essentially mid-marriage contracts, to address the changing economic realities of the couple. If the couple decides that one partner will pause their career to focus on the family, the financial planner will work with them to structure a plan that accounts for this change in earning power, potentially through formalizing contributions to a retirement account in the non-earning spouse's name, or setting up specific savings vehicles that provide future security. The resistance to this level of transparency is almost entirely psychological. We are conditioned to believe that love and money should remain separate, that the act of quantifying the marital partnership is inherently unromantic. But consider the reality of the modern U.S. economy. We are dealing with unprecedented levels of debt, extreme market volatility, and a legal system that is becoming increasingly bureaucratic and expensive. In this environment, transparency is not a cold, calculated move. It is an act of care. It is a way of protecting your partner and yourself from the most common, avoidable, and destructive risks that families face today. By treating the marriage as an actively managed portfolio, you are not planning for divorce. You are planning for the long-term success of the household. You are ensuring that both parties understand their roles, their responsibilities, and the status of their combined wealth. You are creating a framework that allows you to weather the storms of life, whether that storm is a career loss, a health crisis, or the dissolution of the marriage itself. You are removing the element of surprise from the equation, and that, in and of itself, is the most powerful tool you have. However, even with the most perfect record-keeping and the most robust audit process, there remains a massive unresolved variable in the equation of marital economics: the legal and systemic cost of the divorce process itself. We have discussed how to structure the assets, how to track the commingling, and how to plan for the long term. But what happens when the machinery of the law takes over? We are about to move into a segment where we look at the actual cost of litigation and the new technologies that are trying to commoditize and streamline this process. We will look at how artificial intelligence and data-driven legal platforms are being used to estimate the cost of divorce, and why the next phase of this transformation is going to be the most disruptive of all. The system is changing beneath our feet, and the way we litigate our lives is being rewritten in real time. Are you prepared to face the reality of the legal machine, or will you continue to operate as if the old rules still apply? The reality of the legal machine in 2026 is that the traditional adversarial model of divorce, where spouses spend months or years fighting in a courtroom, is increasingly being viewed as a systemic failure of efficiency. We are currently witnessing a massive technological shift in how family law is practiced, driven by the need to lower costs, increase predictability, and move away from the performative, high-conflict litigation that has defined the last few decades. The data is clear. The most successful outcomes in 2026 are achieved not through better courtroom posturing, but through strategic, data-driven preparation and the utilization of legal technologies that were not even mainstream a few years ago. Consider the case of Michael and Sarah, a couple in a major U.S. metropolitan area who sought to dissolve their union in early 2026. Instead of entering the standard reactive litigation pipeline, they engaged with a modern family law firm that utilized an integrated litigation technology suite. From day one, their case was managed through a platform that automated the intake of financial disclosures. Instead of spending weeks manually gathering and formatting years of tax returns, bank statements, and investment portfolios, the couple uploaded their digital documents into a secure portal. An artificial intelligence system then synthesized this information, created a consolidated marital balance sheet, and identified potential discrepancies in real time. This eliminated the back-and-forth demands for information that typically fuel conflict and drive up attorney fees. The efficiency here is not just about time saved. It is about removing the friction that leads to emotional escalation. When the financial picture is presented objectively and transparently through a neutral digital interface, the room for debate over whether an asset is marital or separate decreases significantly. The software does not have an ego, and it does not have an interest in escalating the dispute to increase billable hours. It simply presents the data. For Michael and Sarah, this meant that the discovery phase, which historically could take months, was reduced to a matter of days. This allowed them to pivot immediately to the actual goal: negotiation and settlement. We are also seeing a rapid rise in the use of AI-powered predictive analytics for settlement assessment. Attorneys are now using these tools to analyze thousands of previous case outcomes in their specific jurisdiction, factoring in variables like the length of the marriage, the disparity in earning power, and the presence of complex assets. While these tools do not determine the outcome, they provide a data-backed baseline for what a judge is likely to do. Imagine if you are entering a negotiation and both parties have access to a sophisticated model that simulates a range of likely judicial outcomes. This transparency forces both parties to recognize the risk of pushing for an unreasonable position. It encourages a rational economic approach where the parties gravitate toward a settlement that falls within the range of what a court would find equitable, rather than holding out for a fantasy outcome. However, the integration of technology into family law is not without its challenges. The rise of digital evidence means that the concept of discovery is becoming vastly more complex. We are now dealing with social media data, encrypted messaging threads, and even location tracking from wearable devices and vehicles. Courts are becoming increasingly sophisticated about verifying the authenticity of this digital evidence. In 2026, forensic experts who can trace assets across digital wallets, cryptocurrency exchanges, and various online platforms are becoming essential members of the litigation team. If you are operating under the assumption that moving your assets into a digital currency or a decentralized platform will hide them from the discovery process, you are drastically underestimating the capabilities of modern forensic accounting and blockchain analytics. Plus, despite the efficiency of these tools, there remains a critical distinction between the automated management of a case and the human-centric work of advocacy. AI can sort through thousands of pages of financial disclosures in seconds, but it cannot navigate the trauma, the complex parenting dynamics, or the emotional reality of ending a marriage. The future of family law is not about replacing the lawyer with an algorithm. It is about a hybrid model where the routine, data-heavy, and administrative aspects of the case are handled by intelligent systems, allowing the legal professional to focus their expertise on the strategic, interpersonal, and child-centered aspects of the dispute. This shift is already creating a competitive divide in the industry. Firms that embrace these technologies are scaling their services, reducing costs for their clients, and achieving faster, more consistent results. Those who continue to rely on manual, labor-intensive workflows are struggling to maintain profitability and are often failing to provide the level of service that modern, informed clients now demand. Plus, this shift toward efficiency and privacy is also being reflected in the increased use of private, virtual mediation. High-profile individuals, in particular, are opting out of the public courtroom system entirely, choosing to settle their marital affairs through confidential, tech-enabled negotiation platforms. They are prioritizing durable financial agreements and workable parenting plans over the performative nature of litigation. The goal is to move forward with their financial security and their reputation intact. This represents a fundamental change in the U.S. legal landscape. The realization that the best way to win a divorce is to make it disappear as quickly and as quietly as possible. Plus, we have now explored the architectural, maintenance, and technological layers of the marital economic transformation. We have seen how the landscape of asset division has moved from an era of manual tracking to an era of data-driven transparency. But as we move forward in this masterclass, we have to address the most significant emotional and economic variable in the equation: the role of the homemaker and the shifting legal definitions of spousal support in an era where long-term alimony is becoming an endangered species. What happens to the partner who invested their time and labor into the domestic sphere, only to find themselves facing a future where traditional support mechanisms are being replaced by finite, rehabilitative solutions? Are you prepared to understand how the new economic math is impacting the most vulnerable partners in the marital contract? Or will you continue to view the history of alimony through the lens of a world that no longer exists? The transition we are witnessing in 2026 regarding spousal support is arguably the most radical adjustment in the history of American family law. For decades, the concept of permanent, lifelong alimony was a pillar of the societal understanding of marriage. It was the safety net, the acknowledgement of domestic sacrifice, and the primary vehicle for maintaining a standard of living after the household split. However, that pillar is crumbling. In its place, we are seeing the rise of a strictly finite, rehabilitative model of support that treats financial independence not as a goal, but as an immediate legal requirement. Consider the case of Linda, a stay-at-home parent in Florida, who dedicated 15 years to managing the household and raising 2 children. Under the old framework, she might have reasonably expected a long-term support arrangement that recognized her decades of domestic labor and the resulting atrophy of her career. But under the 2026 statutory reforms in Florida, permanent alimony is no longer an option. The court's focus has shifted entirely to durational and rehabilitative support. This means Linda is no longer being supported for who she was or what she sacrificed during the marriage. She is being supported only for the time it is statistically projected to take for her to re-enter the workforce and reach a level of self-sufficiency. This is a massive psychological and economic pivot. The legal system is effectively telling the lower-earning or non-earning spouse that their time outside the workforce is a liability they must now liquidate as rapidly as possible. The rehabilitative alimony plan is not just a payment. It is a contract with a defined end date, often tied to specific milestones like the completion of a certification program or the children reaching a certain age. If the spouse fails to meet those milestones, the support does not necessarily continue. The burden of proof has shifted. The recipient must now prove their ongoing need and their diligent efforts toward financial independence. The data shows that this transition is accelerating. States like California are also making major adjustments, such as the implementation of SB 711 in early 2026, which aligns state tax treatment of spousal support with federal law. While this simplifies the filing process, it changes the financial dynamics of every negotiation. By eliminating the tax deduction for the payer and the tax burden for the recipient, the net after-tax cash flow for many families is shifting. The result is often lower total support amounts, as the parties and the courts adjust to a system where the government is no longer subsidizing the divorce through tax loopholes. +1. This change highlights a critical, often ignored reality. The marital contract is increasingly viewed by the state as an individualistic, transactional arrangement rather than a communal, collective one. This is further complicated by the rise of shared parenting arrangements. Research suggests that as equal shared placement of children becomes the default, the economic well-being of the primary caregiver, traditionally the mother, is further strained. Because support obligations are calculated based on time sharing, an equal split often leads to a reduction in the support that would traditionally have been used to cover the fixed costs of maintaining a household. The math of the 2026 divorce is forcing families to operate with much narrower margins for error. We have to understand that the system is no longer interested in maintaining the pre-divorce standard of living for both parties. It is interested in achieving a clean, predictable, and finite break. For a stay-at-home spouse, this means the window for planning your own economic future is not just open. It is closing at an accelerated rate. You are no longer just a partner in a household. You are an individual responsible for your own long-term financial solvency. This brings us to the most uncomfortable question of all. If the state is withdrawing its support, and the legal system is optimizing for efficiency rather than fairness, who is responsible for the gap? We are seeing the early development of insurance-based products designed to bridge this divide, to offer a form of income protection that was once implicitly provided by the marriage itself. In the next part, we will explore the burgeoning world of marital indemnity, and why the most innovative insurance firms are now looking at the household not as a sentimental unit, but as a high-risk financial instrument that needs to be hedged. We will look at the potential for private, portable income insurance that could replace the defunct safety net of permanent alimony. The transition is complete, the landscape has changed, and the survivors of this new era are those who have stopped waiting for the law to protect them and started building their own fortifications. Are you ready to see how the insurance market is stepping into the vacuum left by the state? We have to be absolutely clear about the marketplace reality in 2026. If you are searching for a traditional insurance policy that pays out a lump sum the moment a divorce is filed, you are not going to find one. The historical attempt to market such products, notably under the brand names like Wedlock, faced significant regulatory, actuarial, and market challenges. These products were largely discontinued because they struggled to align with the core principles of insurance. Insurance, by definition, is designed to hedge against unpredictable, accidental events. Divorce, while often devastating, is frequently the result of long-term relationship dynamics that do not fit the traditional actuarial model of an insurable risk. However, the absence of a specific divorce insurance policy does not mean that the insurance industry is indifferent to the financial risks of marital dissolution. Instead, we are seeing the rise of a sophisticated, multi-layered approach to risk management that effectively serves the same purpose. This is what industry experts call a patchwork of coverage. It is a strategic integration of existing insurance products and legal instruments designed to protect net worth and provide income security in the face of a relationship's end. Consider the role of life insurance in this new framework. In many high-asset divorces, life insurance is no longer just a death benefit. It is a critical instrument for securing spousal and child support obligations. We are seeing a trend where divorce settlements mandate the maintenance of high-value term or whole life insurance policies, with the ex-spouse or the children as irrevocable beneficiaries. This transforms the policy from a sentimental protection into a mandatory, enforceable financial asset that guarantees the availability of support payments, even if the paying spouse dies. This is not insurance against divorce. It is insurance against the catastrophic failure of the support system following a divorce. +1. We are also seeing the expansion of what is broadly termed legal insurance or legal expense coverage. Many employee benefit programs in 2026 now include access to legal networks that provide discounted, or in some cases covered, access to family law attorneys for mediation and uncontested divorce proceedings. While this does not cover the high-stakes litigation costs of a complex, contested divorce, it does provide a critical layer of financial padding for the routine, administrative costs of ending a marriage. It is a way of mitigating the baseline transaction costs that can quickly drain a household's liquid assets during a separation. Furthermore, the concept of marital indemnity is increasingly being addressed through proactive wealth management. Financial advisors now routinely incorporate divorce risk assessment into the broader financial planning process. They are working with couples to create liquidity buffers, maintain separate asset classes, and structure investment portfolios in a way that minimizes exposure to communal liability. They are essentially coaching couples to self-insure. The logic is simple. By maintaining a robust, well-documented, and liquid financial position that is not entirely dependent on the continuity of the marital unit, you are creating your own insurance. The most innovative insurance firms are now looking at the potential for specialized income protection products that could, in theory, cover the loss of spousal support in specific, well-defined scenarios. These products would not be tied to the divorce event itself, but to the loss of a specific income stream that the household relied upon. This is a subtle but critical distinction. It shifts the focus from the marriage to the underlying economic dependency. While this market is still in its infancy and faces significant regulatory hurdles, the economic demand is undeniably there. The industry is responding to the fact that for the modern American household, the most significant risk is not the death or disability of a breadwinner, but the economic fracture of the domestic partnership. This transition to self-insurance and specialized, modular coverage is the ultimate pragmatic adaptation. It moves the responsibility away from the state and the courts, and places it directly into the hands of the individuals who are managing the risks of their own lives. It is a fundamental shift toward an era of financial autonomy, but there is a final darker side to this transformation that we must confront. As the legal system becomes more efficient, the insurance market becomes more sophisticated, and the financial structures become more rigid, what happens to the human, emotional, and social consequences that can never be fully quantified by a balance sheet? In the next part, we will explore the social cost of this economic optimization. We will look at how the commodification of marriage is impacting the decision-making process for young people entering into partnerships today, and why the most successful long-lasting unions are those that are actively resisting the temptation to view their lives exclusively through the lens of risk management. The math is clear, but are we losing something vital in the process? The tension between the cold calculation of marital economics and the inherent unpredictability of human intimacy is the defining challenge for the American family in 2026. As we have documented throughout this series, the systems of law, finance, and insurance have evolved to provide unparalleled clarity and protection for the individual within the marital unit. Yet, as we optimize our lives for risk management, we have to ask a profound question. At what point does the systematic preparation for the end of a relationship begin to undermine the structural integrity of the union itself? Consider the case of a young couple like Marcus and Elena, who are planning to marry in late 2026. They are both highly educated, career-focused professionals who have been raised in an era where the data regarding marital dissolution is ubiquitous. They have seen their friends navigate the complexities of property division, support obligations, and legal battles. For them, the decision to engage in a formal, data-driven approach to their marital finances is not seen as an act of cynicism. It is seen as a baseline requirement for maturity. They have already drafted a detailed, transparent prenuptial agreement, established separate accounts for their individual earnings, and set up a joint account only for specific, pre-agreed household expenses. From an economic perspective, this model is robust. It minimizes the potential for future conflict, provides a clear roadmap for asset management, and insulates both parties from the most destructive impacts of a potential dissolution. But look closer at the behavioral side of this equation. By constantly focusing on the individual financial defenses of each partner, are they inadvertently fostering a culture of hyper-individualism within the home? The traditional model of marriage relied on a deep, often irrational degree of trust and total economic commingling. It was a leap of faith. The modern model is built on verification and contractual security. We are moving from a system of trust to a system of proof. The data in this area is complex. Longitudinal studies from sociological researchers suggest that while financial clarity is a strong predictor of stability in the early years of a marriage, there is a point of diminishing returns. When financial management moves from being a tool for cooperation to a source of ongoing, granular scrutiny, the psychological impact can be corrosive. We see this in the increasing trend of professional couples maintaining entirely separate financial lives, where they essentially operate as roommates who share a mortgage and a romantic life. While this avoids the friction of financial disputes, it also prevents the development of a shared economic identity, which has historically been a major pillar of long-term partnership success. Imagine if Marcus and Elena, in their effort to be perfectly fair and perfectly protected, never truly take that leap into a shared life. They never fully merge their goals, their risks, and their rewards. In the event of a crisis, a job loss, a medical emergency, or a major investment opportunity, their reflexive response is to protect their individual interests first. This is a perfectly rational economic strategy, but it is not necessarily the foundation for a resilient, long-term romantic bond. The risk here is not economic. It is social and emotional. We are optimizing our families for a high-turnover world, and in doing so, we may be making it easier for those families to actually turn over. We are also witnessing a shift in the cultural narrative for young people in the U.S. There is a growing movement toward what is being called the intentional marriage. This is not about reverting to the past, but about explicitly discussing and agreeing upon the economic structure of the union before the vows are exchanged. It is about recognizing that the modern world requires a new kind of social contract. This movement acknowledges that the state and the church are no longer the only entities dictating the terms of marriage. The individuals are. They are creating custom-made agreements that balance the need for individual protection with the desire for true, deep, and vulnerable partnership. This is the most critical lesson of this entire masterclass. The tools we have discussed, the legal instruments, the insurance products, the data-driven mediation platforms, are just that, tools. They have no inherent morality. They do not dictate whether your relationship will succeed or fail. They only dictate how the economics of that relationship will be handled. The success of the union remains in the hands of the individuals. The most successful, long-lasting partnerships in 2026 are those that use these tools to create a foundation of security, which then allows them to focus on the things that actually matter: the shared goals, the emotional connection, and the mutual investment in each other's success. They are using risk management to buy themselves the freedom to stop worrying about the worst-case scenario and start building a life together. However, even with this ideal balance, the global economic reality is constantly shifting, and with it, the nature of the marital contract. As we move into the final stages of this series, we have to look beyond our own borders. We have to examine how international trends in marital law and economics are going to impact the U.S. landscape over the next decade. We will see why the mobility of capital, the increase in international marriages, and the globalization of the labor market are creating a brand new set of challenges that our current, state-based system is ill-equipped to handle. We are moving toward a future where the marital contract may no longer be a matter of local law, but a matter of international standard. Are you ready to see how the next phase of global economic integration will rewrite the rules of your own home? Or will you wait for the international courts to set the terms for you? The final frontier of marital economics is not found within the borders of any single nation. It is being defined by the increasing mobility of capital, labor, and families in a truly globalized world. As we look at the landscape of 2026, the traditional U.S.-centric view of marriage and divorce is rapidly becoming insufficient. We are witnessing a rise in international marriages, dual citizenship households, and offshore asset holdings that are creating a new, highly complex set of challenges for the legal and financial systems. Consider the case of a professional couple, Elena and Thomas, living in New York. Elena is a citizen of Spain, and Thomas is a U.S. citizen. They own a vacation property in Mexico, hold investment accounts in Singapore, and their primary marital residence is in the United States. If their marriage were to face dissolution, the question of which country has the authority to hear the case, the question of jurisdiction, is not a simple one. It initiates a high-stakes competition between competing national legal frameworks to determine the final distribution of their global assets. In this context, the strategic race to the courthouse is the first, and often the most decisive, move. Because international law does not provide a simple rule for which case takes precedence, the first nation that assumes jurisdiction typically controls the legal framework for the entire dissolution. For high-net-worth individuals, the difference between filing in a community property state in the U.S. versus a separate property jurisdiction abroad can result in a massive multi-million-dollar discrepancy in the final property division. Plus 2. This global complexity is exacerbated by the globalization of the labor market. We are seeing more couples who move across international borders for career opportunities, which directly impacts the residency status and the habitual residence of their children. Under the Uniform Child Custody Jurisdiction and Enforcement Act, UCCJA, and international treaties like the Hague Convention, the habitual residence of the child is the primary factor in determining which court has the authority to make custody decisions. This is not necessarily the country of the child's citizenship, but rather the place where they have lived and integrated into the community. If a parent moves a child across international borders without the other parent's consent, the legal process to secure their return is a clinical, high-speed race against time and conflicting nat iona laws. The financial aspect is equally challenging. When assets are spread across multiple continents, the the standard financial disclosure process is insufficient. We are seeing the increased use of complex shell companies, foreign bank secrecy laws, and decentralized digital asset platforms to move wealth beyond the reach of traditional discovery. For forensic accountants, tracing these assets in 2026 requires specialized expertise in international blockchain analytics and cross-border regulatory compliance. The threat of asset dissipation is magnified in an international context, where a spouse can transfer liquid assets to a non-extradition country in mere minutes. This has forced legal teams to secure emergency measures, such as Marital injunctions or temporary restraining orders, to freeze global accounts across multiple time zones. Plus 2. The recognition of foreign divorces is another critical point of conflict, governed by the principle of comity. Just because a divorce is finalized in one country does not automatically mean that it will be recognized in another. This creates a state of legal limbo where a person might be considered divorced in one nation, but remain legally married in another. This can lead to conflicting orders regarding support, property rights, and even the legality of subsequent marriages. For families in this situation, the administrative burden of ensuring their legal status is consistent across all jurisdictions is a permanent, ongoing struggle. Plus 1. This globalization of marital economics is not going to slow down. As the labor market becomes more integrated and families become more mobile, the need for a more consistent, internationally recognized framework for marital contracts is becoming obvious. We are moving toward a future where the marital contract may no longer be a matter of local law, but a matter of international standard. The tools we have discussed, the prenuptial agreements, the forensic accounting, the active asset maintenance, are now becoming essential on a global scale. The successful families of the next decade will be those who anticipate these cross-border complexities from the very beginning. They will understand the implications of their international ties. They will document their asset ownership with global enforcement in mind, and they will work with counsel that has a clinical understanding of both domestic and international law. We are documenting the transformation of a fundamental societal institution, and the transformation is global. In the final part of this series, we will synthesize everything we have learned. We will provide a comprehensive guide on how to evaluate your own position, how to apply these lessons to your own financial life, and why the ultimate hedge against the uncertainty of the future is not a single product or legal document, but the conscious, informed, and active management of your own economic destiny. The final piece of the puzzle is you. Are you ready to take full ownership of the math of your life? Or will you remain a passenger in a system that is rapidly evolving beyond your control? Taking ownership of the math of your life is not a one-time event. It is a disciplined, ongoing practice of economic vigilance. We have spent the last 9 parts of this masterclass deconstructing the transformation of marital economics in the United States. We have moved from the historical era of social contracts to the current reality of hyper-individualized, transactional partnerships. We have explored the shift from litigation to mediation, the rise of defensive financial engineering, and the emerging, albeit cautious, integration of insurance and technology into the family law sector. Now we arrive at the synthesis. The central thesis of this deep dive is that the American household in 2026 is a high-risk financial instrument. It is exposed to the volatility of the labor market, the complexity of modern asset classes, and the systemic high-cost nature of the divorce process. If you approach this instrument with the naive hope that it will naturally look after itself, you are positioning yourself for a potential economic catastrophe. The path forward for the informed individual is based on 3 foundational pillars: transparency, structural design, and proactive maintenance. Transparency is the first pillar. This goes beyond the basic disclosure of bank accounts. It requires a radical, consistent honesty about your financial goals, your risk tolerance, and your individual economic vulnerabilities. In the most successful partnerships, this is formalized through regular, structured financial audits. Imagine the discipline of a household that reviews its net worth, evaluates its title structures, and reconciles its beneficiary designations every quarter. This is not about suspicion. It is about alignment. When both partners have a clear, real-time view of their economic entity, they can make decisions that strengthen their combined position rather than accidentally undermining it. Structural design is the second pillar. This is the deliberate, legal, and financial architecture you build around your life. It starts with the recognition that the state-provided default rules of marriage are often insufficient for the modern professional. By utilizing prenuptial and postnuptial agreements, you are not predicting failure. You are taking control of the rules of the game. You are defining the terms of your household's economic reality before the pressures of life, career transitions, market downturns, or personal change have the chance to distort your judgment. This is about building a foundation that is resilient enough to withstand the shocks that are, in the modern world, a matter of historical trend rather than an anomaly. Proactive maintenance is the third pillar. The most robust financial structure will fail if it is allowed to stagnate. Life is dynamic, and your marital economy must be dynamic as well. This means actively managing your assets, updating your legal documents as your portfolio changes, and utilizing the new technologies that are transforming family law. It means understanding that the tax implications of asset division are a primary cost driver, and taking steps to structure your holdings in a way that minimizes exposure. It means treating the marital partnership as an actively managed portfolio, where you are constantly rebalancing your risks to stay aligned with your long-term goals. We have also seen that the insurance industry is evolving. While the ideal of a divorce insurance policy remains elusive, the reality of marital indemnity is emerging through the strategic use of life insurance, legal expense coverage, and specialized income protection. The informed individual in 2026 is no longer waiting for a product that does not exist. They are building a bespoke safety net using the tools that are available. They are self-insuring, they are hedging their risks, and they are preparing for the worst-case scenario with the same level of analytical rigor they apply to their retirement or their business investments. The most critical takeaway from this series is the realization that the system is moving away from the paternalistic protection of the past and toward an era of radical, individual responsibility. The state is no longer an active participant in your marital economic success. It is a bystander that only becomes involved to mediate the inevitable, and often expensive, dissolution. You are the sole architect, the manager, and the risk officer of your household's net worth. This is not a message of cynicism. It is a message of empowerment. By accepting the reality of the modern U.S. economic landscape, you gain the ability to act with intention. You gain the freedom to build a life that is secure, not because of a social expectation, but because of a deliberate, well-executed strategy. You gain the clarity to enter a partnership not with fear, but with a full documented understanding of the terrain. As we conclude this series, consider the case studies we have reviewed. Those who emerged from their marital transitions with their financial and emotional capital intact were not the ones who got lucky. They were the ones who were prepared. They were the ones who treated their lives with the same seriousness they applied to their careers. They were the ones who viewed the math of their household not as a source of stress, but as a source of information. The future is going to demand even higher levels of literacy. As global integration continues and the complexity of our digital lives grows, the challenges of marital economics will only escalate. The institutions that once provided stability are changing, and the responsibility for navigating that change falls squarely on you. You have been given the tools, the data, and the perspective to master this field. The path to economic clarity is wide open, but it requires the courage to face the numbers and the discipline to maintain the structure. This masterclass is just the beginning. The real work happens in the silent, consistent, and proactive decisions you make every single day. The math is laid bare. The structures are available. The responsibility is yours. Are you ready to lead? Or will you continue to be led by forces you have chosen to ignore?